This is Robert Kraft, and I'm your host on the Planet MicroCap podcast. And joining me today is someone who I'm sure you guys have seen interviews that he's done in the past. You know about Willow Oak, Arquitos. The guy wears a lot of hats. I'm going to explain them first before I even say that. Steven Kiel, that's who I got on today. He is the president of Willow Oak Asset Management, a subsidiary of Enterprise Diversified Inc., publicly traded company. The symbol is SYTE on OTCQB. Steven is the chairman of Enterprise Diversified. He's also the president and chief investment officer for Arquitos Capital Management. I've been a follower of Willow Oak for a long time and happened to interview two of the brilliant minds that run two of their affiliated funds, Jeff Gannon from Focus Compounding and Dave Waters from Alluvial Capital. And with that, Steven, welcome to the Planet MicroCap podcast.
Thanks, Robert. It's great to be here on the show with you. Appreciate all of the previous interviews you've done. Looking forward to this one.
Thank you again for joining me and for listening in and checking us out. And so with that, as I do with all my guests on here, I'd love to start off with your background. Where did your passion for investing come from?
Yeah. Well, before I started the fund, I was an attorney actually in private practice. I practiced for several years. Started a RIA, small RIA, managed accounts with friends and family. This was about 11 years ago. And then about 3 years after that, started the fund. But if you go back before that, even as a young kid, I was one of those kids that had a paper route, saved my money, had these kind of capital allocation decisions that you make as a 10-year-old, which baseball card pack should I buy? We traded baseball cards. We did all that kind of stuff. So this is not necessarily a unique experience, but it is a way to learn about opportunity cost, allocation of capital, and capital might not always be money. Sometimes it's the value of a baseball card or something like that. And the hard work, quite frankly. I had several jobs at a young age, blue collar jobs. I kind of grew up lower middle class, and so I had to buy kind of a lot of my own clothes. If I wanted something, I'd have to buy it myself. And so I was out every morning with paper route and, on to high school, had jobs there, worked through college as well, in law school. But along the way, this was actually I think it was 1996 when that Buffett biography, the Lowenstein one, Making of American Capitalists, came out. And I remember reading that. I graduated high school in 96, went off to college, and just kind of interested in it. I didn't think I would actually have a career, in finance, but was always interested in businesses. Certain family members had small businesses and things like that. I thought that would be something I would get into. Went to law school after college and joined the Army Reserves as well. And about 20 years in right now, I'm an attorney in the Army Reserves. Had a deployment in 2005, and when I got back from that deployment, I lived in Washington D.C. at the time. And I was heavily involved with public policy and some politics and things like that. Got a little burnt out from that, quite frankly, after the military experience. And, I'd been investing on the side individually. And when I came back from that, I thought, well, this is something I really enjoy doing. Maybe I can make a career out of it. And I was practicing law. I practiced law for another 5 or 6 years after that. But it saved up some money on the side, started investing for friends and family. And again, started doing the managed accounts on the side as well. It was fun. It was successful. And from there, launched the fund and continued. But I'd say the experience with the legal world, we did, we'll get into this later in the podcast, I'm sure. But, I had some cases where we saw some behind the scenes things with public companies, and it was an interesting experience. And it really showed that, I don't want to say they're idiots in every area of life, but some of these people who lead very large public companies, you'd be surprised at the decisions they make, when you're seeing some of the details behind the scenes. So that was an interesting experience.
Absolutely. Well, first thing I want to say, thank you for your service. That's incredible. Let's keep going. Let's follow up there. From your time being an attorney, because that sounds like that really served a lot of what maybe your current investing philosophy is today. So
yeah,
listen, don't name names for companies or anything like that, but like what's some of the things you saw that you're like, okay.
Yeah. Well, so I was always historically what you would consider, whatever the definition of a value investor is, a bottom up fundamental investor. And that experience when I was an attorney, where you're seeing there were government investigations into a few public companies. There were like some M&A stuff, some second requests, things like that, FTC things. And you're reviewing different documents that are relevant to whatever the allegation was or whatever has to do with this merger. You're seeing emails, you're seeing memos and reports and things like that. And it really humbled me, quite frankly, that, some of these companies, it's clearly I wasn't investing in any of these companies. I wasn't doing anything like that. I wasn't able or allowed to. But, there are companies that you would think these are well-respected companies. And you're seeing some of the comments by the CFO that are just totally out to lunch. It's like the old Carl Icahn empty suit analogy. And it actually did make me appreciate Icahn a little bit more, to be honest. But that gave me a little bit more of an idea to look for company-specific situations. So we're looking bottom up in different investments, and it humbled me to things that could happen and also opportunities, because I worked on some cases. They had spinoffs, had divestitures, mergers, different things going on like that, and you could see how much value could be created by these different company-specific transactions. And so I definitely got more interested in that. It eventually led me to some opportunities in some companies that might have tax loss carry forward, some tax benefits. They might have been going through some unique transaction, even things like CVRs and contingent value rights and things like that. I definitely got very, very interested. I appreciated some of those things that I would say previous to that experience, I was kind of a buy and hold, maybe large cap, mid cap kind of investor. And, and again, experiencing that and seeing the spinoffs and reading about Joel Greenblatt, that was at the time in the mid 2000s when You Can Be a Stock Market Genius came out, and you saw these special situation opportunities, like ways to do it. And that had a big impact in my style.
Gotcha. So, I mean, how is that? Okay, so let's continue on, because I want to get to where we're at today. So,
Yeah.
okay, so you started, managing some funds, manage accounts, that kind of thing when you started
Sure.
the fund. So where did the concept for Willow Oak Asset Management come from? How did that get from where you were to where we're at today?
Yeah, in 2015, myself and a few other partners took over the small public company. It was called SiteStar at the time, which is why the ticker is still SYTE. We got on the board. We ended up replacing management, or there was some issues with management that caused them to resign. And in 2016, we knew Dave Waters. He had started his fund, or his firm, Alluvial Capital, where he was doing managed accounts at the time. Loved what Dave was doing. We had shared some ideas, really respected his style. And he's very passionate about what he does, has a long runway, which is an important thing, in the asset management world. The earlier you can start, the better if you're good. And we had the idea that we would launch a fund with him, seed him to allow him to start a fund, because for those people out there who trade and invest in small companies and unlisted companies and things like that, it can be really difficult to do in a managed account structure, especially when you have some accounts that are relatively small and some that are fairly large, and you're trying to kind of make sure your transactions are the same across all these different portfolios. It's just much easier to do in a fund structure. And then it's really difficult to do like rights offerings and things like that, and different little characteristics like that. You can't do it very well in the managed accounts. And so, we talked to him, started the fund. We raised some capital for the public company, and we ended up investing in that. And so the purpose was then for Willow Oak Asset Management, we created it in mid 2016 in order to make the seed investment with Alluvial. And then from there, we did several other things. We decided we could expand on that, really like that business. We get a fee share from it. We have the investment returns. But then we launched an internal fund with Keith Smith called Bonhoeffer Fund the next year. And then ultimately, teamed up with Focus Compounding as well to help them launch a fund. And then with Arquitos Capital, which is my fund, I use them now. I use Willow Oak to outsource my operations. So Willow Oak has a fund management services where there's an entire team that can handle whether investor relations, compliance, liaisoning with all the auditors, administrators, and service providers. And it's really freed up my life to not have to handle, all that day-to-day operations and logistics. And now, compliance is much better, due diligence, all those items are the equivalent of a much larger fund. And so that's a service we offer through Willow Oak to outside funds. And then internally, we're looking for opportunities like we did with Bonhoeffer, where we started a fund with him, and looking for opportunities with Focus Compounding, where we took a piece of their overall company to help them launch the fund and handle their operations as well.
I don't mean to take another step back, but I have to, because, I think what's interesting is that, and this is so, I mean, most of the people that maybe started a fund and that's not what they originally were, doing in life really, or investing wasn't, they didn't think that eventually they were going to be a fund manager. Investing started off as a hobby, so for you, what made you switch? Like what then made you say, okay, I want to pursue this full time? And then I would assume that you did so well that you're like, okay, I think we could turn this into a fund.
Yeah, absolutely. And so did well during the crisis. And, I had been investing earlier before that as well. And, 03, 04, 2001, 2002, but got a little more serious about it in 04 and 05, even when I was deployed. And then the crisis happened. And quite frankly, I was interested in potentially doing it as a field, when the crisis hit. And I was considering going to get an MBA. I was considering going to apply to be an analyst somewhere. The crisis happened in 07, 08, late 07, 08, and early 09. And, there's no jobs. And who I loved at that time were, Klarman and these types of people. And, Michael Price and all those, I'm not going to get a job there. I had no specific experience, and I had legal experience, but I didn't even have an MBA, and didn't have a CFA and those types of things. So, when we're coming out of the crisis and all those jobs disappeared, and there were a ton of compliance jobs, I could have got a legal job somewhere for a fund, for, investment bank, et cetera. Would not have been a problem at all. But then you get pigeonholed into that. And so I thought, well, let me just practice for a few more years and start to see, first of all, see how I performed during the crisis with my own money and a few other accounts that I was managing. And then see if it was possible to kind of start doing it on the side through managed accounts and see where it goes. And so that's what happened, and did well through the crisis, well enough to have confidence to start the firm and go from there. And then even when you start the firm, the thing is, when you're an investor and you love investing, you're doing it on the side, maybe you're trying to determine if you can do it full time. You don't think about all of the other aspects of actually having a fund or having managed accounts or dealing with an RIA, all those operational and logistical things. And even though I was an attorney, those are still things that I had to learn. I had to use service providers for. It was not fun to do. You're starting a business, right? And it takes away from the time that you're able to do research and manage the portfolio. So, it took me several years, actually, even when I started the fund about 8 years ago, it took several years to really feel comfortable with everything on the operational side. And, then going back to kind of the purpose of Willow Oak and some opportunities here, that's, if I would have had Willow Oak and those types of operational infrastructure early on when the fund, I'm sure I would have done a lot better. I mean, we did well performance-wise, but I'm sure I would have done a lot better. I would have been much happier. I would have been much less stressed. And I could have spent more time on research and actually a little bit of fundraising as well. So it took a few years to really appreciate all of that operational stuff. But yeah, on the investing side, it's I think that what ultimately made me decide to want to do it full time was, I'd go on vacation and I'd bring 10Ks to read. That's what I enjoy doing on vacation. And so if you can make a career out of that, then you're never really working,
That's funny because I just had Dean Trottier. He's a full-time private investor, and he was saying the same thing. He was like, I'd be on vacation and I still want to go and check out what's going on in my portfolio.
Now I have free time to do the research I've been wanting to do.
I love that. All right, so let's dig into a little strategy. We were talking offline how we were trying to define, or not really trying, but just saying, what is the definition of these various types of investors out there? I'm not going to say one or the other, so with that, keeping that in mind, how would you describe yourself and your strategy?
Yeah, so a bottom-up fundamental investor. I would describe it a little bit more of as a special situation type of investor. I'm looking for company-specific things. And so what I want to do is reduce the risk of kind of the markets as a whole and increase the risk that I'm taking for the company itself. So, in this specific time, we're in the middle of this COVID-19, things are shut down. Certain sectors have sold off. I mean, certain things have really, the market's kind of gone way up again, but certain sectors have sold off, and there are particular companies in those sectors that are not the same, as the other companies, but they get sold off because of they're in the same index or because they're all in the same sector, and people are just indiscriminately selling. And so that's where there's some opportunities today in those types of things. And this not just today, this happens intermittently. And the opportunity is to find which company is not like the others, even though they might be in the same industry, to gain some amount of confidence that your analysis is correct, and to have the discipline, I think, to hold it over a long enough time period where the thesis can be realized, or the market can start to appreciate again what you might have appreciated now. And so I like to own things that I'd like to own things over long time periods. I like to own them where there's something company specific going on at the point of purchase, and that's why there is a mispricing. But then you have to give it enough time to transition, either because the market appreciates what the operations are already happening, or because there is some sort of transition that's in the process of occurring. And I do something called balance sheet to income statement investing with those types of things, where you're finding opportunities because of the strong balance sheets of particular companies, particularly small companies, for this type of strategy. And then you have to give it time to implement whatever strategy that they're changing, where they have reinvestment opportunities. You have to give it time for that to happen. And sometimes that's years. And as time goes by, a new type of investor comes in. When I'm interested in a company, the only investors in it are watching it are generally other balance sheet style investors who are really looking at a price to book type of thing, or liquidation value, or anything. And to get multi-bagger opportunities, a whole different type of investor has to come in. So with a company like this, and I can think of one, MMA Capital is a good one that I've been with for 7 years now, 6 years. And it's transitioned from being that strong balance sheet to having now great reinvestment opportunities where they make a more predictable return, and they become income statement type of companies. Well, then at some point, you get people who are investors who are coming in, who are willing to pay some sort of multiple of an income statement characteristic. And that's going to be that point, the stock price is going to be much higher than where it was when the balance sheet investors come in. And the balance sheet investors then end up selling off to the income statement investors. My goal is to hold it throughout the whole time period.
It's interesting, a lot of private investors, when they're looking at, because MMA Capital, that's MicroCap, a lot of private investors I've had on here, and just in general that focus in microcaps, are always looking for opportunities where it's either special situation, a spinoff, and it's prior to any kind of institutions being involved or any real institutional money. But what's funny is that it sounds like you guys are trying to position yourselves as like that first institution to find some of these, maybe just before they're ready for some of these other firms out there.
Well, that's where there's opportunities. How do you find a company that has safety on the balance sheet that's mispriced to such a degree that is interesting to me? And this is where the value, I don't know what the definition of value investing is, but ultimately for me, it means I don't want to pay a lot of money for this stock. I mean, look, I love particular companies. You look at it, whether in Amazon or Facebook, or these types of great companies, fine. I just can't have MasterCard, Yeah, it'd be great if I could have bought MasterCard at 30 times earnings. And it continues to, perform over the last 25 years since it's been public, but I could never get myself to buy it at that multiple. And so this is my way around that, where, one, there's less analyst stuff coverage. And this is back in the day when analyst coverage was, there weren't as many individual kind of investors sharing research and things like that like there is today. But you're looking for companies that, you have an information advantage basically with. And then, as time goes by, there also has to be, I don't want to use the word catalyst because I think that's kind of you don't want to buy things for catalysts, so that you're really fooling yourself that you'll be able to identify that typically. And then you don't know what the stock is actually going to do once that happens too. But you want something on the horizon, some opportunity on the horizon. And, for MMA Capital, for example, they got into the Russell 2000 last year, right? So I'm looking for things that are not in indexes, but that will be in an index in the future. Or something that does not have analyst coverage now, but will in the future. So it has to have that growth opportunity too, that growth potential.
That's interesting because those type of, again, I guess I'll just use catalyst or maybe growth driver. I don't know, one of those buzzwords, I guess we'll use. Yeah. Visions. I ask vision a lot. So visions, goals, I guess, right? It's interesting because what you just mentioned, those are things that are really more stock related to the company, right? I mean, that fits with what your style more or less is, but when you're talking company specific, are there any things that you look for in particular where you're like, whether it's a new trend or an industry, like what are some of those things that you look for?
So certain characteristics, you want to find them really before others do. And the best characteristic is the company and the leadership, are they good capital allocators? And when you think of larger companies, it's very obvious to say, to choose, look at Mark Leonard at Constellation Software, even Buffett, look at John Malone, look at even in a different way, Jeff Bezos, even Mark Zuckerberg in his own way. It's not my style of investing, but he's done well with the things that they've acquired. And so, how do you define whether they're a good capital allocator or not, especially with smaller companies? You almost need to know, or you need to have certain clues or incentives before they can prove themselves, because it's easy 20 years later to say, yeah, that guy was a great capital allocator, but now it's too late because you've already, the company's too big or the multiple's too high or something along those lines. And you can win on those types of things, but then you have to wait for, sharp market corrections. And those, hasn't happened for 10 years until earlier this year. But so how do you find these things early? So you have to look for certain characteristics. And I think the incentives are a big thing. So that's why I was involved with some of these tax loss carry forward companies before the tax law changed, many years ago. You had things like, okay, what does the insider buying look like? What's the history of buybacks for the companies themselves? Are they doing it at opportune times? Are they doing divestitures and spinoffs? Are they making acquisitions at fair prices when strategically it makes sense to do that? And you can look at and gain a lot of information with smaller companies and you can have a huge information advantage by looking back and examining those decisions that they've made. And you can even talk to management in a way that they'll be open with you that you can't do with larger companies. And so, what can you do to ballpark whether this team and this company is a great capital allocator or not? And you can piggyback off of other activist investors, quite frankly. Lloyd Miller, he passed away a few years ago, but a lot of people followed him. He was in a lot of small companies, Peter Kamen as well. These other, follow 13Ds, follow these activists who've taken over companies and then done things with them. And, so that's what I've tried to do. You look kind of, you're not guessing, but you're trying to see, you don't have full visibility. So you're following clues. And the clues are, when are they doing buybacks? Why and when are they making insider purchases? What are they doing with regards to different corporate transactions? Are they doing rights offerings at opportune times to take advantage of an opportunity and not just to, allow the company to survive, for example? Are there tax loss carry forwards? And this is less relevant today, but back in the day, were there tax loss carry forwards that potentially could incentivize an activist getting involved?
All right. So I don't mean to transition real quick, but you did talk about capital allocation, and this has been something that's been asked of me, in some of our interviews. I'm seeing comments from our Twitter and YouTube and whatnot, and people are very curious about, how investors are deploying capital in times of crisis. You talked about you talked about in your bio that you were investing during 01, 2000, that the bubble, and then then the recession, 07, 08, 09, and then now here we are, we're in a global crisis, COVID-19, the whole thing, so how do you manage your capital and your investment decisions during times like these?
Yeah, so the greatest advantage you can have is a long-term time horizon. And so when you're a bottom-up fundamental investor, first of all, nobody's going to get the timing right unless it's luck. I mean, even going into the crisis in 08, 09, you watch The Big Short. I mean, they're 2 years early, 3 years early. Yes, they're right, but sometimes early is not enough. Sometimes early is wrong because, if you have other investors or outside investors, if you run a fund, and early can be wrong for you as an individual investor if you don't have the discipline to stick to your thesis. And this even goes for companies like Amazon and Microsoft. In 1998, you buy these companies and they're the same price for 15 years, basically, or 12 years or whatever, 8 years. And that's really difficult to do, to just sit there, even if it's your own money and you don't have outside pressure from your investors in a fund. But so, so what do you do? First of all, in this crisis, there is a crisis going on. The stock market crisis lasted a very short amount of time. And people wonder, oh, hey, why didn't Buffett put money to work? And, Buffett's actually been selling some stuff and things like that, trying to raise more capital. And there's other issues related to maybe his risk assessment and the insurance side and other things like that to make sure they're bulletproof. But the other end of it is he really only had 3-week period, a month period to actually put something to work. And if you're trying to acquire a company, that's not enough time. If you're trying to buy stuff on the open market, but there's uncertainty on the operations, that can be risky too. We don't know what's going to happen. We don't know what earnings are going to be. You could apply some sort of normalized thing, but this is a crisis where companies can disappear and go bankrupt. And so it's very difficult when you have a 1-month kind of time period to take advantage of this, that you're trying to assess whether companies are either going to survive, let alone normalized earnings, or when that'll happen. And especially when the companies that, the stocks that cratered the most are the ones that legitimately were most at risk. And, again, there's opportunities here and there in that, but it's difficult. It's very difficult. And so I don't think you go back and you say, well, this is an obvious opportunity, this crisis. And it didn't feel like an obvious opportunity even in 08. And even back in 2001, and after 9/11 and things like that, these are difficult times. It's very easy to look back and say, oh, if I only would have bought this company at that time, or if I only would have bought the index or something like that. But when you're going through it at that time, it's difficult. And it's not just difficult from an emotional perspective. And, we're trying to be disciplined, we're trying to be analytical and things like that. It also is difficult from an analysis perspective. As someone who's looking at the specifics of the companies and trying to make predictions, 5, 7, 10 years out, about what the long-term, kind of cash flow generation of these companies will be. So it's not easy, and it's you don't want to be the one kind of throwing rocks at other investors, say, well, if you would have just put it to work during this time period. Now that being said, there's a lot of work to do, especially in this time period, because it's been a relatively short amount of time where the market cratered and then came back. And there's might be some opportunities in the future. I'm a little bit negative about the current overall environment as well, but then again, it's being propped up by certain institutions too. But we'll see what happens over the next 6 months or a year. But you look back at 08 and you had a decent amount of time. You had from March 08, when Bear Stearns fell, up until when Lehman fell later that year, 6 months later. So I think when country companies got sold to Bank of America, I think it was in like March 08. People thought things were stabilized. I mean, you had about a year there to really analyze things and make some predictions, and look at things in industries that were not directly affected. So it's tough. I'd say for people kind of watching and listening right now, look for sectors that have sold off, that have not recovered, and look for companies that are not like the other ones. And so, there's a particular company, I'm not going to share the name right now because I'm still acquiring some of it, but it's a mortgage REIT. It yields 15%. It's a microcap. It's a sub $100 million company. And it does not have collateral calls. It doesn't mark to market. It has a partnership with an outside funder where the repayments are guaranteed, virtually guaranteed. So it doesn't have the same risk, but it dropped, it dropped 70%. And now it's come back another 50%, but it's got another 50% to go, quite frankly. And right now it's yielding 15%. And so, those are the things you're looking for, right? And then the other thing is some things that you may already own that may have dropped that you have some confidence in. Those companies better than companies that you're starting to look at now. And part of the whole thing is you need to have the discipline and confidence to hold a company, hold a stock over this entire time span. So not just the next 6 months, but the next year, the next 2 years until all this comes up. And it takes time to build that confidence in a particular holding. And so if you have it in a current holding, maybe that's the time to double down on it.
Right. And it's hard, especially when you're talking to maybe people that didn't have any assets at work, prior to everything, to the pandemic. And, you sometimes hear people out there saying, or I've asked a few investors out there, like, well, what can you do to get prepared? And you said to yourself, and, hindsight's 2020, of course, but in the midst of it, we didn't know how long this initial kind of volatility was going to last for, really, what was it, like a month and a half, if that, so like, the normal thing would be, especially if you haven't deployed any capital, is like, okay, well, now's the time to do the work and see what maybe opportunities might be out there. And who knows, we're still relatively early, I guess you'd say, in the pandemic. So things might not be as rosy as we see, and there's other forces at play. But it's difficult because if you hadn't had a watch list or a wish list going into this, it's kind of like, well,
and you have to be willing to get early too, because, again, and however long this thing lasted until, really the NASDAQ's positive on the year now. But, you think, we've got a few months here. I can do some work now on some new names and then see what happens. And then by the time the whole see what happens thing it's gone, the opportunity's gone. And even in some larger companies, these things, it happened. There's still some stuff out there, I think, but I think the issue now is some things that are cheap, at least for mid-cap or larger companies, you can do some sort of multiple of, normalized earnings. You can do some kind of, look at kind of, deeper long-term metrics. What are their margins going to be? What's ROE look like? What's ROIC look like? You just don't know what those inputs are. And you don't know what those inputs are going to be in a couple of years. And that's challenging. I think where you really find some opportunities are in some smaller companies. And what I've generally looked at, not only now, but also during the crisis and even going back to the early 2000s, look, when there's insider buying and where people from sober leadership, certain companies, not kind of these people that just do it for show. If there's insider buying, it's something to look at. If you want to run some sort of screens, do it on insider buying type of things, do it on activists, increasing their positions, do it on some insider transactions, some share buybacks and things like that. So that's generally what I've been looking at during this for some names on the watch list or new names, or to see that it's happening in some existing names as well. Because, especially if like a CFO is buying a significant portion of their net worth during this time period, that's not the CEO who is generally more marketing oriented and understands that. If it's a COO, if it's a CFO, or these are operational finance people, and they're putting a significant amount of their salary or net worth to work now, that's a company that's worth taking a look at. Absolutely.
All right. So I want to switch topics a little bit. You actually brought this up a little bit earlier, and you started, this you didn't bring up earlier, but you guys just recently started on your YouTube channel, Value Hour, and you featured a few interviews with both friends and fund managers that are affiliated funds, really talking about the recent Berkshire Hathaway meeting. So we don't have to get into. I mean, look, we could do another 3 podcasts just on that right now. But what were some of the main takeaways that you saw from that, especially with regard to where we're currently at in our global economy?
Yeah, it was sobering, quite frankly, to watch this on. I mean, it's nice that we're able to do it virtually, but he's sitting up there in the auditorium alone. And I go to the annual meeting. I've been going the last 12 years or so. And it was disappointing not to be able to go, certainly. But someone like Buffett, he's 89 years old. And I think this was one of the guys, either Jeremy Deal or Thomas Brazil, made this point during our interview, that this is his birthday, essentially. It's like a birthday party every year. He's 89 years old, and he loves interacting with the shareholders. And they love interacting with each other and with him as well. And he doesn't get to do that this year. And it's sad. It's sad. It's sad that Munger wasn't there. It's sad that he's kind of sitting alone in a huge auditorium. And, there's uncertainty for sure. You could sense the uncertainty from him also. There's long-term confidence, which he always has, but the short-term uncertainty is real, and certainly related to the insurance aspects, but also these companies that he had just been buying just a few months earlier. You think about the airlines, you think about different things like that. He trimmed, he just trimmed almost completely the Goldman Sachs stake. He trimmed some of the banks. He's in a different situation than any of us are in terms of capital allocation decisions. His universe is much smaller than ours, so we should not just follow his lead. But at the same time, that cautiousness, we really should be humble to that, because he's seeing information in certain industries that behind the scenes information. And these might be industries that actually are investable type of businesses and industries that we might do. But he's seeing day-to-day sales figures, and other things like that. And, one thing to keep in mind when you think about in this environment, there's going to be cost cutting. There already has been cost cutting. CapEx, we've seen this across the board with companies. One company cutting CapEx, that's another company's revenue, and if you're extrapolating some sort of normalized revenue, normalized earnings and things like that, and if there's any sort of debt on a company that could be the recipient of that revenue loss, you can really get into trouble fairly quickly there. So you should be cautious, and you really should. Although the Fed is lowered interest rates or made these loan programs and things like that, it seems like it's a safe environment to carry a lot of debt on the balance sheet. You got to be really careful as an investor with those companies with a low amount of debt, even if it's low interest rates, because again, the revenue is going to be uncertain. And I think even the insiders in some of these companies are not going to realize right now, are not realizing what the effect is going to be 6 months or a year from now. So anyway, that's one kind of takeaway is it's just sad. It was disappointing not to be there. The cautiousness is sobering and humbling, and I think we should take that. And it doesn't mean there's not opportunities for us, but we should take that into account in some of our estimates. And then beyond that, you've got, you miss Munger too. He had a nice interview a couple of weeks earlier that was entertaining, but him not being there and not being there with Buffett, and at their age, these are inspirational figures for most of us. You don't have to agree with everything they do, but Buffett was the reason why I got excited about investing in 1996 when I read his bio, that original bio. And you realize that these are, he's 89 years old. He hadn't had a haircut in a while. His PowerPoint skills were effective yet simple. But his age is there, and he's not going to be with us forever.
That's for sure. I mean, it's sad because it just feels like an opportunity lost, right? I know a lot of people every year now. That's the main bucket list. Got to go to Omaha. Got to go do this. So it just sucks that
Well, we catch up with people there. There's other parties and ancillary events. It's good there's people I see once a year there just to catch up. But think about what it is for the city of Omaha. That's such an economic positive for the city.
And that's just a microcosm for other cities in the country around the world,
Other events like that, right?
Vegas, New
Comic-Cons,
Orleans.
look at film festivals, look at sporting events, and the effect that this has had on the economy worldwide. The Olympics were were delayed. I mean, all of those cities, we've not seen the effect as of yet. And I think look over the 6 months, a year, even a couple of years, it's tough. There's going to be restaurants, retail, certain retailers who are filing bankruptcy. There's going to be restaurants that don't come back. Now, look, I don't want all this to be a negative. It is a negative, and people are losing their lives. It's a very sad situation. But this is all part of capitalism. It's all part of creative destruction. It's all, this is, we wouldn't choose it. This is like forced out upon us. But the companies that survive and thrive are those that are finding ways to do things better, more efficient, more effective. And as investors, we have to look at that, and we have to see which companies are able to not only survive, but which companies can take advantage of opportunities, which can take market share, which can take over other competitors, which can more effectively allocate capital. This is the time where we can look back in the next year or two, look back to today, that the decisions that are made at specific companies, this is how we find those new people, new managers, new leadership that are great capital allocators. They're the ones making decisions now that we can watch. And those are companies we might want to, be invested in the future. So it's again, the creative destruction happens. We can't stop it, even if we want to. It still happened under communist regimes and socialist regimes and things like that. It happens on the black market. So this is like human nature. And as outside observers, as investors, we're kind of more observers there. We have, let's look for companies that not only are surviving, but also can thrive now and in the future.
No, absolutely. And look, it's pretty interesting to be a conscious investor right now. And what I mean by that is, back in the last recession, I was, I guess for me personally, I was still an undergrad. I didn't think twice about this, and then back in 9/11, I was, 11 years old, I had no idea of, the global economic effects, and so it's really interesting to see what's happening right now, because this is unlike anything else that's ever been in existence. Let's be frank.
Well, the ramifications that'll happen 5, 7, 10 years from now, we can't even predict. 9/11. Look, I was deployed in 2005 because of 9/11. I joined the Army Reserves in 2000. I would have never imagined. You think of, there's a great Josh Wolf quote. It's essentially, I'll paraphrase it, but risk is what's left over after you've thought of all the things that you could think of. Risk is what's left over, basically. That's the idea behind it. We would have never thought that when I was in 2000 that 9/11 would have happened. I would have been in Iraq 5 years later. The global economic crisis in 08, 09, look, that ultimately led to Trump being elected, quite frankly. Whatever your political view is, good or bad, but it led to that populism on all areas of the spectrum. There were things in 2010, 2011. It had the global and regulatory ramifications. Everything that happened with the banks afterwards and all the regulations associated with that. And, not only that, but day-to-day kind of activity, right? So there will be ramifications from this. They could be political. They could be, certainly will be regulatory in some fashion. It could lead to war type situations as well, even just regionally, not just, it's not a great way to put it, but regionally as well. And we're not going to know, even 10 years from now, we're really not going to know. And so it's really, we don't want to go out predicting to think that the world will be the same in 5 years as it was 5 years ago.
Yeah, no, I think it would be a mistake to think that everything's going to go back to normal and it's going to be a completely new normal. I mean, look, for me personally, I'm not getting on a plane anytime soon. I'm not going to a restaurant anytime soon. It's sad for me to say, but it's the truth, right? I mean, I don't think any of us want to, unless we have to, really, right? But anyways, I mean, look, we're all hoping that there is at least some sort of new normalcy that just, at least we get back to some
Well, we need a new
percentage
term,
of what it
because
was.
we had Bill Gross's new normal after 08, 09. I don't know what right. We could go back. I think, was it Truman that created the word normalcy or normality? It was actually supposed to be normality. And I think he said normalcy or something like that.
Let's just listen. Let's ask Michael Lewis. I feel like if there's anybody out there that can come up with a good term for what we're going to, it's Michael Lewis. He's my favorite author. So
well, think of the movies that are going to come out of this too, like The Big Short. I'm just talking about investing. Let's not talk about human tool. We want to, right. But yeah, in 08, The Big Short and all that, the Bill Gross and people who got, John Paulson and people who became famous from that. Who's going to come out of this, in the next year or two as the next wave of kind of famous investors? It'll be interesting to watch.
I mean, it could be Steven Kiel. Who knows? I mean, we'll see.
Well, I had a great hedge on. Unfortunately, I sold it a little too early, talking about selling too early on something. I had a 100-bagger as a hedge. Very small position, but it actually went up 110 times. And it did protect part of the portfolio, but I sold it, trimmed it along the way a little too early, unfortunately. But yeah, you never know. And especially, I think there's opportunities for smaller funds for sure. That's why we're doing the stuff with Willow Oak, why we have, why you interview a lot of these smaller fund managers also. And, they're in my kind of orbit and discussion. These are people who I commiserate with and share ideas with and things like that. And, I think there's real opportunities for smaller companies and investors, whether professional investors or individual investors in smaller companies where you can have really multi-bagger opportunity, asymmetric gains, and at a low risk.
Yeah. No, you're right. I mean, look, the main reason I love interviewing some of these smaller fund managers is because there's a lot more creativity that you need to have. As you go up the ladder and you go up the scale, you kind of have to. There's only a certain pool that you can really play in. I mean, not a lot of these larger firms can even really do anything, and not just small nano, but or not even just micro and nano, but even small cap. Right. Yeah. So that's why it's interesting to me, because that's where you really hear the diverse opinions of, we talked about, I don't even know how to define value investing. Guess what? How do you define investing once you start talking to some of these smaller fund managers and how they're deploying capital? Right. So
very unique. Yeah. It's unique and impressive. And I agree. The creativity there is amazing. And even more so now than, when I started 15, 20 years ago or so, and professionally 10 years ago. People use Twitter in a way that you would have never imagined 10 years ago. Right. Well, think about like Dan Loeb back with his Mr. Pink persona, on these message boards 15 years ago or so. And, he parlayed it into what he has, and there'll be people, and there have been people who are doing it with Twitter now.
Gotcha. All right. Well, I want to get to one question that I like to ask every guest that I have on here. What investing experience would you say had the greatest impact on your career?
Yeah, so I mean, I think going back to from a more recent thing was going back to when I was a lawyer and seeing those behind the scenes types of things. But if you want to go back to the beginning, I do remember, as a kid when I was delivering newspapers. I lived in Florida at the time, and I had a route, and my sister had a route like next to it. So take me like 45 minutes or so to do my route, and she had to do hers next to her at the same time. And then she wanted to give hers up, right? And so I said, I'll take over your route, but it was too many papers for a bike. And so my dad said, hey, Steve, I'll help you buy a golf cart, $600. I had $300 to put up. He goes, I'll loan you the other $300, and you can pay me back over a certain time period, a certain interest rate, and things like that. And my dad was like not an experienced capital allocator or anything like that, but so I'm 10 years old, and I thought, okay, well, what's the rate of return? Okay, how soon am I going to make that $300 back? I get this extra money from my sister's route, et cetera. And, so it's an interesting capital allocation thought process at 10 years old, where you're saying, well, I'm making kind of a capital investment into the, to the golf cart. I'm getting additional revenue, which allows me to have kind of, additional kind of margin, so to speak. And so you're actually kind of thinking like a little businessman, right? Now here's the thing where I really had an advantage of that I didn't know at the time, though, was that, the golf cart had to get charged up every night. My dad never like charge me extra for the electricity in the house. So I had that kind of ongoing expense that I never kind of experienced. But it's good, I think, for anyone who has children, teach them little things like that at an early age. They say, well, if you have some sort of an allowance or some sort of like side job or something like that, is there a way for you to appreciate CapEx, maybe a loan repayment? What sort of decisions can you force onto a kid at a young age that they might remember? Look, this was 30 years ago for me. And I remember this anecdote, and it actually had a pretty good effect, and it made me appreciate then in high school when I started reading kind of business related books. It made me appreciate them and have a foundation.
Right. Well, you
got me more interested.
I was going to say, you were able to actually say, hey, I did that with my paper route.
Yeah. So here's a rate of, what should I pay off the principal now, or should I continue at, this 5% rate of return? When should I do that, et cetera, et cetera? What additional revenue that was I able to do, and things like that. And I think that's, when you think of a big thing, how do you get people, like kids, interested in business, not just stocks, not just trading, because we're not talking about trading. We're talking about analyzing a business and then determining if the value of it is appropriate or not, a value measured by the stock price. And, I think you get them interested at an early age, just with those little everyday things like that. And then when they confront it in school, or they confront it in some book that they're forced to read later on, they'll actually have a foundation. And that's where the interest, that curiosity comes from. And so, I had that, and that led all the way to, again, when I was an attorney, saying, you know what, this CFO is not making that decision that I would have made as a 10-year-old, and there's something off here.
For sure. So my next question is, and by the way, thank you for taking all this time. I know we've covered a lot today.
We can do it again.
For sure. So my next question, and again, this is one of the questions I do ask everybody, and that's really advice for, as I usually say, for new investors, but with you, because of, your fund management services business, you have so much experience in helping launch new funds and managing them, for, investors that have been successful and now looking at maybe starting a fund. What advice do you have for those individuals that might be looking to start a fund?
Yeah, if for people out there who are looking to start a fund, don't underestimate that you're actually starting a business. You're not just investing. There's a lot of work involved that's not what you want to do. When you don't want to get up and say, well, now I'm gonna reread these documents, or I'm gonna pay a lawyer to do this. And you actually, even if you're paying a lawyer to do it, you still need to understand it yourself. Or you're helping an investor fill out the offering docs, or even if it's managed accounts, just going through the process with all that. There are a lot of logistical operational things. Wait till you're an RIA, you're going to get audited by the state. They do that every few years. And all the record keeping, all of that is very, very, very important. Right when you start off, you've got to get that right. You've got to make sure your fee structure is right, your operations are right, your compliance is good. You're doing everything, by the book with the state. And with any other types of things, any other type of regulatory bodies. And so you got to get that right off the bat, because you don't want to get, the reputation that you kind of did something wrong, and then later you're screwed later on. That's on your mark. And quite frankly too, you have to have the appreciation that you're managing. If you're an RIA, you're a fiduciary for other people's money. Not just in the way that you're investing, but also in the way that you're handling all the record keeping and compliance and operational things. So, I would be very careful. You want to do that right. You want to really take the time, make sure your service providers are ones that you want to be with for a long time. You're going to have to invest in that, set enough money aside as well. When I started the fund, I was still kind of working when I started the managed accounts. And then, you want to make sure you saved up a couple years worth of returns, of expenses, not just for the company, but also for your living expenses. Because the thing is, you could be the greatest investor in the world. This thing happens, some black swan type thing happens, which somehow these black swan things happen like pretty regularly, every 10 years at least. And what happens if you start at a difficult time? And you're starting to get a few investors, your performance right off the bat is not good, because of things that might even be beyond your control. And then you think you're going to raise additional money and you're not able to. And if you don't have kind of those savings, and if you don't have the discipline or that really long-term perspective, then you can run into some short-term problems there. So, I just be careful. I'd say, if it's your passion, do it. Make sure it's your passion though. It's something you want to do for life, and it's not something you just stumbled upon a couple of years ago. Again, I've been investing for 10 years. I've been kind of interested in business stuff 15 years before I even started doing this with other people's money professionally. So make sure it is something that you're going to enjoy, far into the future. And it's different managing your own money as it is managing other people's money. For some people who manage other people's money, it changes their risk profile. It changes their decision-making. There's emotional elements that get kind of brought into the decision-making that wasn't there before. And you might've been a great investor individually. But what happens if you have a down, year or two, and you've got an outside investor questioning you? Are you going to be confident in your strategy even through that? And sometimes, what if that outside investor is your mom, or your cousin, or something like that, who's close to you, and now you're having to answer those questions, a good friend. So it's not as easy as it seems. And, so you have to be confident, but realistic confidence. Realistic. I mean, you have to be humble that you could be wrong. And where you're confident, make sure you actually do have the experience enough that confidence is legitimate. But look, if it's your passion, go for it. Make sure you save some money aside for a couple of years for living expenses, for unforeseen things. Make sure that your operations are correct, whether you do it yourself, which I did myself, or whether you take on or discuss it with an outside service provider, which may be like Willow Oak that handles operations for things like that. And there are probably some others out there as well. And so, make sure you have everything in order and realize you're starting a business. You're not just kind of expanding as an investor. And there's a huge time commitment to that. And there's a financial commitment as well.
Well, with that, we're there. Before I let you go real quick, just want to make sure we get some proper disclosures in there on maybe some of the companies mentioned. You mentioned that you are a shareholder of MMA Capital. Are you a shareholder of any other companies that you mentioned throughout the podcast?
I think we mentioned Berkshire, which I own a couple leaps, but nothing substantial. They had some leaps on Berkshire, which I would not, no recommendations here or there. I don't think we mentioned any other companies, did we?
Constellation Software.
Oh, Constellation Software, Microsoft, Amazon, no other holdings
Google,
there.
Yeah. Gotcha. Cool. All right. Well, with that, Steven, thank you so much for joining me today. I really do appreciate this. Of course, we got to ask, where can my audience go and find more information about Willow Oak Asset Management?
Yeah, absolutely. So, willowoakfunds.com. We have been doing some videos on YouTube, which you can go to Willow Oak Asset Management on YouTube. Twitter, Arquitos.com is my fund. And I'm pretty active on Twitter as well. Just search Steven Kiel, Kiel, or search Arquitos.
Perfect. All right. With that, Steven, thank you again so much for joining us today. I really appreciate it. Stay safe. Good luck. And I look forward to our next chat.
You too. Thanks so much, Robert.
Thank you.